Dollar yen is back above 160, and yet again the BOJ intervention threat is front and center. Yet despite all the talk from Japanese authorities, traders continue to favor a stronger dollar and a weaker yen. Part of the reason comes down to what happened following last week's Federal Reserve meeting. While intervention threats and Middle East headlines have clouded the picture on occasion, one relationship has started to stand out yet again, and that's US-Japanese 2-year yield spreads with a correlation coefficient of 0.82 over the past week. As seen on the left, markets now price around 48 basis points of Fed tightening by the middle of next year, while yield spreads shown on the right have widened to more than 280 basis points in favor of the US dollar. That's important because it suggests markets are becoming increasingly focused on the US side of the equation. And if that's the case, the events and data capable of altering the Fed outlook may matter far more for dollar yen than anything coming out of Japan this week. So when looking at the calendar, that's where I'll be focusing my attention. At first glance, Thursday's core PCE deflator looks like the main event, but I strongly disagree. Economists have become exceptionally good at mapping this release using CPI and PPI data published earlier in the month, meaning surprises these days are very rare. So unless we see a major deviation from consensus, I'm far more interested in what Christopher Waller and New York Fed President John Williams have to say. Governor Waller is often viewed as sitting close to the center of the committee's thinking, while Williams has historically leaned more dovish. If both reinforce the hawkish shift outlined by Kevin Walsh following last week's FOMC meeting, it would likely ring alarm bells for yen bulls. On the Japanese side, the most important release this week arguably isn't even on the economic calendar. The BOJ's underlying CPI inflation rate, excluding government measures report, will be released at 2 p.m. Japan Standard Time on Tuesday. The latest reading painted a very different picture to the official inflation data. While Japanese core CPI rate slowed to 1.4% in April, the BOJ's adjusted measure sat at 2.8%. More importantly, it bottomed at 2.2% in February before starting to re-accelerate, suggesting that underlying inflationary pressures are not nearly as tame as the headline national figures would have you believe. The release takes on added importance because it arrives just ahead of a raft of BOJ speakers later this week, including Governor Ueda and noted board member Tamura. If the measure remains elevated in May, it may be interesting to see whether they continue to run with the hawkish tone struck by Deputy BOJ Governor Himeno late last week. With another hike this year all but priced, they'll likely need to if they don't want to add further pressure on the yen. Finally, on the threat of intervention, short speculative positioning in the yen has hit the most extreme level since mid-2024 last week, according to latest data released by the CFTC. That creates the potential for a sharp bout of short covering if the MOF instructs the BOJ to act. But as we saw earlier this year, those positions may be rebuilt quickly given it goes against prevailing fundamentals. To be clear, intervention remains a risk with dollar yen above 160. But until the US side of the equation starts to falter, the stars remain aligned for further upside in the pair. Best of luck with your trading. I'll catch you next time.